We've continued building exposure to commodity markets over the past 2 months, coming from a low of around 20% exposure or active exposure in December last year. Exposure currently sits at around 60%. We're most heavily exposed to the energy sector, precious metals and industrial metals. Over the past 2 months, we've continued building active exposure to commodity markets. We're currently sitting at approximately 60% exposure. Now, this is up from a low of approximately 20% as of the end of last year. Our performance has been quite good. Last month in the webcast, we discussed the ability of H3 to quickly and efficiently deploy capital as markets improved, and we've certainly done that over the course of this year. As commodity markets certainly have rallied, and that's been reflected in our performance year to date. We're basically going neck and neck with the commodity benchmark, and we're currently sitting at plus 7% year to date, which is pretty much in line with the index. We've continued building exposure to primarily energy markets. We've seen a substantial rally in crude oil since the March lows. We've seen a rally from the high $30 levels as of last night. In fact, we saw crude oil trade through the $70 mark. So we've continued building exposure there, and one point of interest to note with crude oil is that we are seeing a flattening of the forward curve, which means that contango effect, where you typically get a negative roll yield, somewhat has been reduced as the forward curve flattens. So it does appear we are returning to some sort of normal structural environment in the energy markets, and we believe at some point we may in fact move back to a backwardation environment where there is actually a positive pickup in roll yield. Precious metals continue to be built within the portfolio. We have over the course of the past 12 months maintained a fairly high and active exposure to gold, and we believe that that will continue to be an important part of the portfolio, purely on the basis of concerns over inflation, and also concerns over there's still a general amount of nervousness in the market about the sheer amount of debt that's being carried by governments globally, in particular the US government. Industrial metals continue to be increased within the portfolio. We are seeing we are basically moving into an environment where we're seeing both supply and demand factors drive commodity prices higher. Consumer and business confidence figures released over the course of the last 5 to 6 weeks have shown a dramatic improvement. So we believe that the demand side is certainly increasing, but the reality is markets, in particular industrial metals, remain very, very supply constrained, and we are seeing massive Chinese destocking in all the bulk commodities, and this is being evidenced by upward movement in prices in coal, iron ore, aluminium and nickel. Over the course of the next few months, a few things that we're keeping an eye on fairly closely are the grain markets. They have been a bit of a laggard in terms of performance, but we do believe there's substantial upside from this point versus their performance against, say, industrial metals and energy markets, which have performed particularly well. We still maintain a relatively low weighting or a significant underweighting to livestock markets, but we believe that that particular sector will show promise over the course of the next few months. One of the themes that we did cover in the last webcast that we did was the weakness in the US dollar and how that will underpin commodity markets going forward. We believe that theme, as we mentioned last month, is well underway. We have seen the US dollar continue to weaken over the course of the last 5 to 6 weeks. That's certainly underpinning more commodity-based currencies such as the Aussie dollar and the Canadian dollar. So there are a variety of factors that we're tracking which are extremely bullish for commodity markets. US dollar weakness, supply constraints, and increasing demand for commodity markets. There is a lot more interest in commodities as an asset class, as there was last year before we saw the sell-off in commodities during the credit crisis, but the whole theme about commodities as an asset class is gathering a lot of momentum, and we're certainly seeing a pick-up in investor demand in commodity markets across the board, and we believe that this will continue going forward.